They appeared in 1929, before 40 million people lost everything. They appeared in 1991, before Japan's economy went silent for 30 years. They appeared in 2007, before the floor disappeared beneath an entire generation. And right now, at this very moment, all three are appearing again. The data is public, the pattern is identical, and almost no one is reading it. Welcome to Dominance Aura, the channel where we don't chase headlines. We study the architecture beneath them. Now, before we go any further, if you've been watching this channel for a while, you already know what we do here is different. So I want to ask you something the same way you'd ask your most trusted elder. Sir, if this conversation has ever made you think differently about the world you're building in, would you do us the quiet honor of pressing that subscribe button? No pressure. Just the way you'd ask a wise person for one small gesture of trust. And one more thing. Where in the world are you watching this from right now? Drop your city, your country, just your continent, whatever you're comfortable with, because the people in this audience are exactly the kind of people the rest of the world will be asking for answers when the signs finally stop being warnings. Let's begin. It is the spring of 2006. Marcus Reed is 34 years old. He owns a small but growing construction supply company in Phoenix, Arizona. 3 employees when he started. 14 now. He's not wealthy, but he is building something. Orders are increasing every quarter. New housing developments are rising across the city like crops after rain. Contractors are calling him. Developers are calling him. Banks are offering him credit lines he never asked for. His accountant tells him the numbers look strong. His banker tells him the market has never been healthier. His competitors are expanding. His suppliers are backlogged. Every signal around him points in one direction, forward. So Marcus does what any rational businessman would do. He signs a lease on a larger warehouse. He hires 3 more people. He takes the credit line. He doubles his inventory order. He is not reckless. He is not gambling. He is reading the information available to him and making the logical decision. 18 months later, Marcus Reed closes his business, not because he made a mistake, not because his product was inferior, not because he failed as an entrepreneur, but because the system he was operating inside of had already been failing for years. He just could not see it, and neither could almost anyone else. This is the first and most dangerous truth about economic crises. They do not announce themselves. They do not arrive with sirens or warning labels. They arrive dressed as opportunity. They arrive during the period when business is good, when credit is accessible, when the headlines are optimistic, and when anyone who questions the system's health is dismissed as someone who simply does not understand how the modern economy works. The popular image of an economic crisis is a sudden catastrophic event, a stock market crash, a bank failure, a moment when everything changes overnight. But that image is wrong. An economic crisis is not a sudden event. It is the final visible moment of a process that began years, sometimes decades, earlier. Think of it this way. A bridge does not collapse the moment it becomes dangerous. A bridge collapses after years of structural deterioration that no one addressed. The collapse happens in seconds. But the failure was decided long before that moment. It was decided during the years when the bridge looked perfectly functional, when traffic moved normally, when the engineers in charge assured everyone the structure was sound. The collapse was just the moment the last beam gave way. Economic crises work exactly the same way. By the time a crisis has a name, by the time it appears in headlines, by the time governments hold emergency meetings and central banks issue statements, the structural failure that caused it has already been years in the making. The crash is not the beginning. The crash is the confession. This matters enormously for businessmen and entrepreneurs, because entrepreneurs are by nature optimistic. They build, they plan, they invest in the future. These are not weaknesses. They are the qualities that drive economic progress. But these same qualities make entrepreneurs uniquely exposed during the final phase of a structural economic deterioration. Because during that final phase, the surface signals look exactly like a genuine growth environment. Credit is available. Demand appears strong. Asset prices are rising. Competitors are expanding. The logical business decision, the decision Marcus Reed made in Phoenix in 2006, is to grow. And so entrepreneurs grow. They hire. They borrow. They expand their operations precisely at the moment when the underlying structure is most fragile. They are not making irrational decisions. They are making rational decisions inside a system that is feeding them distorted information. That is the trap. Across every major economic crisis in recorded history, 1929, 1991, 1997, 2008, the same pattern holds. The businessmen and entrepreneurs who suffered the most were not the reckless ones. They were the ones who trusted the signals. They were the ones who read the available information correctly and acted on a system that was lying to them. 3 specific warning signs appear before every economic crisis. They are measurable, they are documented, they are visible in public data, and they were all present long before Marcus Reed signed that warehouse lease. There's a number that almost no one tracks, not because it is hidden, not because it is classified or buried in some government database that ordinary people cannot access. It is published openly, updated regularly, available to anyone with an internet connection and 15 minutes of focused attention. But it is not the number that appears on the front page of financial newspapers. It is not the number that television anchors report with urgency. It is not the number that politicians cite when they declare the economy is strong. And yet, this single number, when it begins moving in a specific direction, has preceded every major economic crisis in modern recorded history without a single exception. The number is the gap between how fast debt is growing and how fast the real economy is actually growing. That gap is the first warning sign. And once you understand what it means mechanically, not theoretically, but mechanically, you will never look at a booming economy the same way again. To understand the gap, you first need to understand what healthy credit actually looks like. In a functioning economy, credit serves a very specific purpose. A manufacturer borrows money to purchase new equipment. That equipment increases production capacity. Increased production generates more revenue. That revenue services the debt and produces profit on top of it. The credit was productive. It created something real. The loan justified its own existence by expanding the economy's actual output. This is how credit is supposed to work, but credit does not always work this way. Credit can also be used to purchase existing assets, real estate, stocks, commodities, in the hope that prices will continue rising. Credit can fund consumer spending that generates no future income. Credit can refinance previous debts that themselves produced nothing of real economic value. In all of these cases, the debt is created, the obligation is real. The interest must be paid every single month without exception. But no new productive capacity has been added to the economy. The economy now owes more than it did yesterday. But it cannot produce more than it could yesterday. That is the beginning of the gap. Now here is where it becomes dangerous for every businessman and entrepreneur in the room. When unproductive credit begins growing faster than productive economic output, the total debt burden of the economy rises faster than the economy's ability to service it. Each passing year, a larger share of all economic activity goes towards servicing existing obligations, paying interest, rolling over old loans, refinancing previous debts, rather than creating new value, new jobs, or new business opportunities. The economy is running faster and faster, simply to stay in the same place. And every year it falls slightly further behind. This is not a theory. It is basic arithmetic. If total debt in an economy grows at 8% per year, and the real economy grows at 2% per year, the ratio between the two expands every single year. It cannot be sustained indefinitely. The mathematics do not negotiate. They do not respond to optimistic press releases or reassuring central bank statements. At some point, the accumulated debt load exceeds the system's capacity to carry it. The only question is how long the gap persists before the correction arrives. History answers that question with uncomfortable precision. The United States, 1920 to 1929. During the entire decade of the 1920s, the era history remembers as the Roaring Twenties, total private debt in America roughly doubled. Meanwhile, real GDP grew by approximately 42%. Read those two numbers again. Slowly, debt doubled. The real economy grew by 42%. The gap between credit creation and productive output widened every single year for nearly a decade. Where did the excess credit go? It went into two places: stock market speculation on an unprecedented scale, and consumer installment lending, Americans buying automobiles, appliances, and furniture on credit for the first time in history. By 1929, broker loans, the credit extended to investors buying stocks on borrowed money, had reached approximately $8.5 billion. Adjusted for the size of the economy at that time, this figure had no historical precedent. The economy looked extraordinary. Industrial production was rising, employment was strong, so the stock market was setting new records almost every single week. Every surface-level indicator pointed to robust, sustainable growth. But beneath that surface, the productive economy was not growing fast enough to support the obligations being constructed on top of it. The credit was not building factories that would generate future revenue. It was inflating prices and pulling tomorrow's consumption into today. When October 1929 arrived, it did not destroy a healthy economy. It revealed an economy that had been structurally unsound for years. Japan, 1985 to 1991. 2. Following an international currency agreement in 1985, the Bank of Japan lowered interest rates aggressively. Cheap credit flooded the entire system almost overnight. Between 1985 and 1990, bank lending in Japan expanded by roughly 75%. Real GDP during that exact same period grew by approximately 23%. The excess credit did not fund new industries or technological breakthroughs that would elevate Japan's productive capacity for the next generation. It funded real estate speculation and stock market investment on a scale the world had never witnessed. By 1989, the total estimated value of Japanese real estate reached approximately $20 trillion. The grounds of the Imperial Palace in Tokyo alone were valued at more than all the real estate in the state of California combined. The Nikkei stock index reached nearly 39,000 points in December 1989. These numbers were not connected to productive output. They were connected entirely to credit creation. When the Bank of Japan raised interest rates in 1990, the credit engine stalled. Asset prices began falling, and they kept falling for more than a decade. The Nikkei did not recover its 1989 peak for over 30 years. Japanese real estate values in major cities fell by 60 to 80%. An entire generation of Japanese entrepreneurs and businessmen, people who had done everything correctly, who had built real businesses, who had planned carefully, watched their net worth, their collateral, and their opportunities evaporate. Not because of their decisions, because of the gap that had been widening silently beneath them for 5 years before the collapse had a name. The United States, again, 1997 to 2007. In the decade before the 2008 financial crisis, total household debt in America grew from approximately $5.5 trillion to nearly $14 trillion. Mortgage debt alone roughly tripled. Meanwhile, real median household income, the actual earnings of the actual working population, grew by less than 2% over the entire decade after adjusting for inflation. 2%. Over 10 years, credit was expanding at multiples of income growth. And once again, the credit was not building productive capacity. It was funding home purchases at prices that had lost all connection to underlying economic reality. It was funding consumer spending on borrowed money. It was funding a financial sector that had grown from roughly 4% of GDP in the 1970s to over 8% by 2006. The financial sector was not producing goods. It was producing instruments, complexity, fees, bonuses. And the gap kept widening. 3 different eras, 3 different countries, 3 completely different political systems and economic structures. The same gap. This is the first warning sign. Not the existence of debt. Debt is a normal feature of every functioning economy. The warning sign is the sustained widening divergence between the rate at which debt is being created and the rate at which the real economy is actually growing. When that gap persists for years, the system is not prospering. It is pressurizing. And pressure does not disappear on its own. It builds until the structure can no longer contain it. There's a moment in every economic cycle that feels like arrival. Not progress, not growth, not momentum. Arrival. The moment when an entire society collectively decides that it has figured something out, that the old rules no longer apply, that this time the numbers make sense at any level. In 1929, they called it the new era of American prosperity. In 1989, they called it the Japanese economic miracle. In 2006, they called it the Great Moderation, the belief that modern financial innovation had permanently eliminated the risk of serious economic collapse. Every generation gets its own version of the same story, and every generation pays the same price for believing it. Because beneath that feeling of arrival, beneath the record stock markets, the rising property values, the confident headlines, and the expanding business opportunities, 2 specific structural conditions are always present. 2 warning signs that are not opinions, not interpretations, not the concerns of pessimists who refuse to appreciate how far the world has come. They are measurable. They are documented. And by the time the majority of businessmen and entrepreneurs recognize them clearly, the window for strategic repositioning has already quietly closed. The second warning sign, asset prices. Detach from economic reality. To understand the second warning sign, you need to understand one precise distinction. The difference between an asset that is expensive and an asset whose price has become entirely dependent on borrowed money to sustain itself. These are not the same condition. An expensive asset can still be grounded in economic reality. Its price may reflect genuine optimism about future earnings, genuine scarcity, genuine productivity gains. Expensive is not automatically dangerous. But when an asset's price rises, not because its underlying value is increasing, but because the volume of credit flowing into it is increasing, something structurally different has occurred. The price is no longer a reflection of what the asset produces. The price is a reflection of how much borrowed money is chasing it. And that distinction matters enormously, because an asset grounded in value has a floor. An asset grounded only in credit flow has nothing beneath it the moment the flow stops. The United States, 1927 to 1929. In the 2 years before the crash, the Dow Jones Industrial Average rose by approximately 60%. Price-to-earnings ratios for major American stocks reached levels that had no historical precedent at that time. The market's rising value was not supported by proportional increases in what American corporations were actually earning. It was supported by margin lending, Investors were borrowing money to buy stocks, using those stocks as collateral to borrow more money, using that borrowed money to buy more stocks. The structure was entirely circular. It required a continuous inflow of new credit to sustain itself. The moment confidence wavered in late October 1929, margin calls began. Investors forced to sell drove prices down. Falling prices triggered more margin calls. More margin calls forced more selling. The Dow Jones fell nearly 90% from its 1929 peak to its lowest point in 1932. It did not recover its pre-crash level until 1954, 25 years. An entire generation of businessmen, people who had built real companies, employed real workers, created real products, lost everything. Not because their businesses failed, because the financial architecture surrounding their businesses collapsed beneath them. Japan, 1989. At the peak of Japan's asset bubble, the price-to-earnings ratio of the Nikkei stock index exceeded 60. For context, the long-term historical average for major equity markets globally is approximately 15. Japanese stocks were priced at 4 times what their actual corporate earnings justified. Real estate in Tokyo's commercial districts was selling at prices that implied rental yields of less than 1%, in an economy where borrowing costs were already beginning to rise. These prices could exist only in one specific condition, an environment of continuously expanding credit. The moment credit contracted, the prices had no foundation. They did not decline gradually, they collapsed. Banks that had lent money against inflated property values found themselves holding collateral worth a fraction of what they had financed. The Japanese government spent the next 2 decades managing a banking crisis that was, at its root, a valuation crisis. The prices were never real, but the losses were absolutely real. The United States, 2005 to 2007. By the peak of the American housing bubble, the median home price had reached approximately 4.7 times the median household income. The historical norm was roughly 3 times. In certain markets, Miami, Las Vegas, Phoenix, and large parts of California, home prices had doubled or tripled within 5 years while incomes had barely moved at all. The S&P 500 was trading at a cyclically adjusted price-to-earnings ratio of roughly 27. The long-term historical average is approximately 16. But here's the detail that every entrepreneur and business decision-maker must sit with carefully. The corporate profits that appeared to justify those stock prices were themselves largely generated by the financial sector, and the financial sector's profits were entirely dependent on the continuation of the same credit expansion that was simultaneously inflating the housing market. The profits justified the stock prices. The stock prices reflected confidence in the profits. The profits depended on the credit expansion. The credit expansion depended on rising asset prices. Remove any single element from that structure, and the entire architecture collapses simultaneously. This is not complexity for its own sake. This is the precise mechanism that transforms a correction into a crisis. The third warning sign: financial prosperity diverges from broad economic health. The third warning sign is the one that is most consistently misread, because on the surface it looks like a social issue, a political debate, a question about fairness and distribution that serious economic analysts should not concern themselves with. This interpretation is dangerously wrong. The divergence between financial prosperity and broad economic health is not a moral observation. It is a structural diagnostic, and it tells you something very precise about the nature of the credit expansion underway, and exactly where the system's most critical vulnerability is located. Here is the mechanism: when credit flows primarily into asset markets rather than productive investment, the people who benefit are the people who already own assets. Property owners watch their net worth rise. Stockholders watch their portfolios expand. Institutional investors accumulate wealth at a rate that has no relationship to the productive work being performed in the economy beneath them. Meanwhile, the broad working population, the employees, the small business owners, the young entrepreneurs who have not yet accumulated significant assets, experiences something entirely different: wages that do not keep pace with the rising cost of essentials, housing that becomes progressively less accessible, business opportunities that require more borrowed capital than previous generations ever needed, and a slow, difficult to articulate but impossible to ignore sense that the economy is working beautifully for someone, but that someone is not them. The United States, 1928 to 1929. In the year before the Great Depression, corporate profits reached record levels. The stock market was setting all-time highs. Aggregate economic statistics looked exceptionally robust. But real wages for industrial workers had been essentially flat for most of the decade. Agricultural incomes had been declining steadily since 1920. Income inequality had reached levels not previously recorded in American history. The top 1% of earners were capturing approximately 24% of total national income. The wealth generated by the entire decade of 1920s prosperity was concentrated overwhelmingly in financial assets and urban real estate. The broad population, rural Americans, industrial workers, small business owners operating outside the financial centers, had not participated proportionally in any of it. When the downturn arrived, this majority had no savings buffer, no asset cushion, no capacity to sustain consumption through a period of economic contraction. Demand collapsed almost instantly. Businesses failed in cascading sequence. Unemployment reached 25%. The concentration of prosperity was not incidental to the severity of the collapse. It was causal. An economy in which the majority of participants lacked the income or savings to absorb a downturn does not experience recessions. It experiences depressions. The United States, 2005 to 2008. Corporate profits as a share of GDP reached levels not seen since the 1960s. The S&P 500 was hitting record highs. GDP growth appeared stable and healthy. But real median household income had been essentially flat since the year 2000. The share of national income flowing to the top 10% had risen from roughly 33% in 1979 to nearly 50% by 2007. Home ownership rates had increased, but they had increased on the foundation of subprime lending, adjustable rate mortgages, and loans extended to borrowers who could not sustain the payments if economic conditions changed even slightly. The appearance of broadening prosperity was not real. It was manufactured by credit products, specifically designed to substitute for the income growth that was not occurring. When housing prices stopped rising and adjustable mortgage rates reset, the borrowers at the bottom of the income distribution defaulted first. Their defaults triggered losses in mortgage-backed securities markets. Those losses triggered losses at the banks holding those securities. Those bank losses triggered a credit contraction. The credit contraction triggered a recession. The recession triggered more defaults. Each layer collapsed into the next with the precision of a controlled demolition. Now observe all three warning signs as a single connected system. Credit growth decouples from productive output. The economy accumulates obligations faster than it generates the capacity to meet them. This creates structural fragility that compounds with every passing year. The excess credit inflates asset prices beyond any relationship to underlying value. The inflation looks like prosperity. It registers positively in every conventional metric. But it is entirely dependent on the continuation of the credit flow that created it. The gains concentrate among asset owners while the broad economy stagnates. The majority of the population substitutes credit for income growth, deepening the very imbalance that makes the entire system fragile. Fragility, illusion, concentration. Each warning sign feeds the next. Credit expansion enables asset inflation. Asset inflation drives concentration. Concentration weakens the broad economic base. The weakened base requires more credit to sustain consumption. More credit widens the gap between debt and output. The system accelerates toward its own failure, not because anyone planned it, but because the incentive structure at every level selects for the next incremental step in the sequence. The loan officer approves the mortgage because the guidelines permit it. The bank packages the mortgages because the market demands the product. The central bank holds rates low because inflation appears contained. The entrepreneur expands operations because every visible signal says the environment supports growth. Every participant is behaving rationally within their own local context. No one is behaving rationally within the systemic context. And no one has the authority, the information, or the incentive to act on behalf of the system as a whole. That is the trap. There's a question that surfaces after every major economic collapse in recorded history. It is asked in parliamentary inquiries and congressional hearings. It is asked in academic papers and post-crisis commission reports. It is asked by journalists, by regulators, by the businessmen who lost everything, and by the entrepreneurs who watched years of careful work dissolve in months. The question is always the same. How did no one see this coming? And the answer is always the same as well. People did see it coming. The data was available. The warning signs were measurable. The structural deterioration was documented in public records that anyone with serious analytical attention could access. The problem was never visibility. The problem was that the system had no mechanism and no political will to act on what the data was clearly showing. And by the time the question was being asked in those hearings and commission reports, the collapse had already completed itself. The question was not a search for understanding. It was a performance of surprise. After every collapse, 3 resolution paths present themselves. Not 4, not 6, exactly 3. And every government, every central bank, and every economic authority in recorded history has chosen from these same 3 options because there are no others. Understanding these 3 paths is not academic. For every businessman and entrepreneur navigating the current economic environment, understanding these paths is the difference between strategic positioning and catastrophic exposure. The first path, controlled deflation. The theoretical ideal. Credit and asset prices are allowed to deflate gradually over a managed period of years. Losses are absorbed incrementally. The productive economy adjusts. Debt levels return to sustainable ratios relative to real output. The system rebalances without violent disruption. This path is clean in theory. In practice, it has never been successfully executed at scale in modern economic history. The reason is precise. The early stages of controlled deflation are politically indistinguishable from economic failure. Asset prices fall. Business investment contracts. Unemployment rises. The population experiences immediate, visible pain, and democratic governments respond to immediate, visible pain. Before the adjustment can complete itself, political pressure forces a reversal. Interest rates are cut. Stimulus is deployed. The deflation is arrested before the imbalance is resolved. The underlying structural problem is not corrected. It is postponed, and postponed imbalances do not diminish with time. They compound. The second path, disorderly collapse. This is what happens when the first path is avoided for too long. When the accumulated imbalance finally exceeds the system's capacity to contain it, the correction does not arrive gradually. It arrives violently. 1929, the Dow Jones loses nearly 90% of its value over 3 years, 25% unemployment. Thousands of banks fail. An entire generation's savings erased in a compressed period of months. 1930, Japan's asset bubble ruptures. Real estate values fall 60 to 80% in major cities. A banking system rendered functionally insolvent. An economy that does not genuinely recover for 3 decades. 1931, Lehman Brothers files for bankruptcy on a Monday morning. Within 6 weeks, global equity markets lose approximately 30% of their total value. Credit markets freeze. Businesses that had no direct exposure to mortgage securities find themselves unable to access operating capital. Unemployment in the United States reaches 10% within 18 months. In each case, the violence of the collapse was directly proportional to the length of time the imbalance had been allowed to persist and deepen. The longer the first path is avoided, the more destructive the second path becomes. The third path, monetary inflation. This is the path most commonly chosen by modern governments and central banks, because it is the only path that does not produce immediate, visible, politically attributable pain. Instead of allowing credit and asset prices to deflate, the central bank expands the money supply. Interest rates are suppressed. Liquidity is injected into the financial system. The nominal value of assets is maintained or even increased. The debt burden does not disappear, but it is gradually eroded in real terms as the purchasing power of the currency declines. The cost of the imbalance is not eliminated, it is redistributed from the holders of financial assets, whose nominal values are protected or inflated, to the holders of savings, wages, and fixed incomes, whose purchasing power quietly erodes year by year. The businessman who borrowed heavily to acquire assets during the boom finds his debt burden lightened in real terms. The employee who saved carefully in cash and conservative instruments finds that his savings purchase less each year than they did the year before. The imbalance is not resolved. It is transformed from a credit crisis into a currency problem. And currency problems have their own terminal trajectory. None of these 3 paths are painless. Every resolution of an accumulated economic imbalance distributes cost across the population. The only variable is who bears that cost, in what form, and across what time frame. This is not a pessimistic observation. It is the most strategically important observation any businessman or entrepreneur can internalize. Because once you understand that the cost cannot be avoided, only distributed, the critical question changes entirely. It is no longer, will there be a correction? It becomes, am I positioned on the right side of the distribution when the correction arrives? History answers the distribution question with uncomfortable consistency. After every collapse in the case studies examined across this analysis, 1929, 1991, 1997, 2008, the documented pattern of outcomes follows the same sequence. The people who absorbed the greatest losses were not the reckless speculators. The reckless speculators lost early and lost visibly. The people who absorbed the greatest losses were the ones in the middle. The businessmen who had expanded operations based on rational readings of available signals. The entrepreneurs who had borrowed to grow precisely because the credit environment rewarded growth. The workers who had saved consistently in the system's recommended instruments, retirement accounts, home equity, pension funds, and trusted that the institutions managing those instruments were operating soundly. They were punished not for recklessness. They were punished for trust. And the people who emerged from every collapse in the strongest relative position shared one specific characteristic: not superior intelligence, not privileged access to information that was unavailable to others, not the ability to predict the precise timing of the correction, because no one across the entirety of financial history has demonstrated a reliable ability to do that. What they shared was pattern literacy. They had studied the structural sequence. They understood the 3 warning signs not as abstract historical curiosities, but as a living diagnostic framework. They recognized the divergence between what the system was reporting and what the system was actually doing. And they made decisions, not in panic, not in cynicism, but with clear strategic intention that reduced their exposure to the specific vulnerabilities the pattern identified. After every collapse, the system rebuilds, regulations are passed, commissions are formed, reports are published, lessons are declared learned. After the Great Depression, the Glass-Steagall Act separated commercial and investment banking. Margin requirements were tightened. The Securities and Exchange Commission was created. These structural reforms held for approximately 50 years. Then, beginning in the 1980s, they were systematically dismantled. Glass-Steagall was formally repealed in 1999. By 2007, the financial system had recreated, in different form but identical structure, the same leverage, the same concentration, and the same detachment from productive output that had characterized the late 1920s. After the 2008 crisis, the Dodd-Frank Act imposed new capital requirements. The Consumer Financial Protection Bureau was established. New restrictions on proprietary trading were implemented. Within a decade, significant portions of these reforms were weakened or reversed. The incentive structures that produced the crisis were modified at the margins. They were not altered at the foundation. The reforms fail not because they are poorly designed. Many of them are expertly designed by serious people with genuine understanding of the mechanisms involved. They fail because the pressures that created the imbalance in the first place do not disappear after the collapse. The political necessity of rising employment, the institutional pressure on central banks to keep credit accessible and growth statistics positive, the lobbying influence of the financial sector, the expectation embedded in democratic politics that asset prices, home values, retirement accounts, investment portfolios will appreciate indefinitely. These pressures reemerge within years of every collapse, and they push the system back toward the same three warning signs, with the reliability of a river returning to its natural channel after a flood. The individuals change, the instruments change, the regulatory acronyms change. The mechanism does not. So where does this leave the businessman and entrepreneur sitting with this analysis today? Not with a prediction. Predictions about timing are intellectually dishonest. No serious analyst, regardless of their credentials or their track record, can reliably identify the precise moment a structural imbalance resolves itself. The history of confident collapse predictions is a long record of being either early or wrong. What this analysis provides is not a timeline. It provides a framework. Examine total credit growth relative to GDP growth in any major economy over the past 15 years. Examine asset valuations, equities, real estate bonds, relative to the income streams and earnings they are supposed to represent. Examine median wage growth versus asset price growth. Examine who has benefited from the monetary policy of the past decade and who has not. The data is not hidden. It is published in central bank reports, in national statistics, in corporate earnings filings, in household debt surveys. It is visible to anyone who examines the structural relationships rather than the headline numbers. Marcus Reed closed his business in Phoenix in late 2007. He spent 3 years rebuilding. He did not rebuild the same business. He rebuilt a different kind of business, smaller, less leveraged, less dependent on the continuation of a credit cycle he had not known he was inside. He could not have predicted September 2008. But if he had understood the 3 warning signs, if he had been reading the structural data rather than the surface signals, he would have recognized in 2005 and 2006 that the environment rewarding his expansion was not built on sustainable foundations. He would not have signed that warehouse lease. He would not have doubled his inventory order. He would have grown more carefully, borrowed more conservatively, maintained more flexibility, not because he saw the collapse coming, because he understood the structure well enough to know that the confidence surrounding him was not the same thing as safety. The 3 warning signs are always the same: credit growth that outruns productive capacity, asset prices that detach from the income and earnings that are supposed to justify them, a concentration of gains that hollows out the broad economic base while headline numbers proclaim health. Once the first condition establishes itself, the second follows. Once the second is underway, the third is virtually guaranteed, not because of conspiracy, not because of malice, because the structure of credit-based economies under the political constraints of democratic governance selects for these outcomes. The way gravity selects for downhill, the pattern is legible right now, in data that anyone can access. The only question is whether you're reading the pattern or whether you are inside it, believing it is something else entirely. This has been Dominance Aura. This analysis is historical and educational in nature. It is not financial or investment advice. Nothing presented here should be interpreted as a recommendation to buy, sell, or hold any asset, security, or financial instrument. If this type of structural analysis matters to you, if you would rather understand the machinery than react to the headlines, you already know what to do. The patterns do not wait for permission, neither should your understanding of them.